The dividend snowball effect is a simple yet powerful tool that can transform your financial future. Whether you start with a lump sum or regular contributions, the key is to stay consistent, reinvest your dividends, and let time work its magic. Remember, the earlier you start, the more time your snowball has to grow. Start small if you must. Even $50 per month can make a big difference over time. The most important step is the first one. Take action today. Your future self will thank you. Picture this: a small snowball rolling downhill. With every rotation, it gathers more snow, growing larger, faster, and more unstoppable. This is the essence of the dividend snowball effect in investing. But instead of snow, the snowball here is made of money, dividend payments from stocks in your portfolio. With every passing year, as you reinvest these dividends, your portfolio grows, generating more dividends, and this compounding effect accelerates over time. Imagine receiving checks from your investments that keep growing larger without you lifting a finger. Sounds like magic, right? Now, the magic of this compounding isn't reserved for the wealthy or financial experts. Anyone can build a dividend snowball and turn it into a passive income stream capable of covering bills, luxuries, and even early retirement. Today, we're diving into the specifics of how you can achieve this. We'll explain 1. How the dividend snowball effect works step by step. 2 proven strategies you can use to start building your snowball, whether you have a lump sum to invest or want to contribute monthly. 3. How to design a diversified portfolio that grows sustainably over the years. And if you stick with us, you'll see how this strategy can evolve into a $5,000 monthly income stream or more. Let's get started. The dividend snowball effect is one of the most powerful wealth-building strategies available to everyday investors. It's based on the principle of compounding, which Albert Einstein famously called the eighth wonder of the world. Here's how it works. When you invest in companies that pay dividends, typically on a quarterly basis, you can use those payments to buy more shares. These new shares then generate even more dividends, which are reinvested to buy even more shares. Over time, this creates a self-reinforcing loop where your portfolio grows faster and faster, much like a snowball rolling down a hill. Let's break this down with an example. Suppose you invest in a stock that pays a 4% annual dividend. If you start with $10,000, you'll earn $400 in dividends in the first year. Instead of spending that $400, you reinvest it, buying more shares of the stock. The next year, your investment grows, not just because of the dividends, but also due to potential price appreciation. Now, you earn dividends on both your initial investment and the additional shares you purchased. By the third or fourth year, you'll notice that your annual dividend income grows faster than in the earlier years. After a decade or two, the growth becomes exponential, and your portfolio starts generating significant income. Income that can eventually replace your salary or cover major expenses. The beauty of the dividend snowball is that it doesn't require you to be a stock market expert. It thrives on 3 simple ingredients: time, patience, and reinvestment. Time is crucial because compounding works best when you give it years, even decades, to unfold. A single year of reinvesting dividends might not make a huge difference, but over 20 or 30 years, the results can be astonishing. Patience comes into play because markets are unpredictable in the short term. Stock prices fluctuate, but if you focus on dividend growth, the long-term trajectory tends to be upward. Finally, reinvesting your dividends ensures that the snowball keeps rolling and gathering size. Skipping reinvestment can slow down your compounding significantly. Here's a mind-blowing fact. Over a 30-year period, reinvested dividends can account for more than 50% of your total investment returns. That's why building a dividend snowball is one of the most reliable strategies for achieving financial independence. Before you start building your snowball, ask yourself, How much income do you need to achieve your financial goals? For example, if your monthly expenses are $3,000, then your target might be to generate $3,000 per month in passive income. If you want to retire early and travel, you might aim for $5,000 or more per month. Once you have a clear target, you can calculate the size of the portfolio you'll need. Let's say you're targeting $5,000 per month or $60,000 per year in dividend income. If you invest in stocks with an average dividend yield of 4%, you'd need a portfolio worth $1.5 million. At first glance, that might seem overwhelming. But remember, you don't need to save that entire amount overnight. With consistent investing, reinvesting dividends, and allowing compounding to work its magic, you can reach this goal faster than you think. Now let's look at 2 practical strategies to build your dividend snowball. The first strategy is for those who have a lump sum of money to invest up front. Imagine you have $100,000 available. You could invest it in a portfolio of dividend-paying stocks with an average yield of 5%. In the first year, you'd earn $5,000 in dividends. By reinvesting those dividends, you buy more shares, which increases your future dividend income. Fast forward 20 years. Assuming a modest annual dividend growth rate of 5% and some share price appreciation, your portfolio could grow to over $400,000. At that point, your annual dividend income might exceed $20,000. If you let this portfolio grow for another decade, the snowball effect could make you financially independent. For those who don't have a large lump sum, the second strategy involves regular monthly contributions. Let's say you invest $500 every month into dividend stocks. Over 30 years, you'd have invested $180,000. But with the power of compounding and reinvested dividends, your portfolio could grow to over $600,000, generating $24,000 per year in passive income. This strategy, known as dollar cost averaging, also helps reduce the impact of market volatility. By investing consistently, you buy more shares when prices are low, boosting your long-term returns. To maximize the growth of your snowball, diversification is key. A well-constructed portfolio should include a mix of dividend aristocrats, dividend ETFs, and high-yield REITs. Dividend aristocrats are companies that have increased their dividends for 25 years or more, such as Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies offer stability and reliable income growth. Dividend ETFs like the Schwab U.S. Dividend Equity ETF, SCHD, or Vanguard High Dividend Yield, ETF, VYM, provide exposure to a broad range of high-quality dividend-paying companies. They're an excellent choice for diversification and ease of management. REITs, or real estate investment trusts, are another valuable addition. These companies own and manage income-producing real estate, and they're required to distribute at least 90% of their taxable income as dividends. Popular choices include Realty Income Corporation and Prologis. By combining these assets, you create a portfolio that generates steady income while also benefiting from capital appreciation.